UK Cycle to Work scheme is a government tax exemption that lets PAYE employees access bikes, e-bikes, accessories and bike share rides through their employer, typically paying via salary sacrifice over 12 months and saving between 28 and 47%. Whilst most people know it as a way to buy a new bike, it is technically a hire scheme. The scheme was introduced in 1999. It's set out in section 244 of the Income Tax, Earnings and Pensions Act of 2003, with operational detail in HMRC's Employment Income Manual at EIM 21664. Salary sacrifice in this context means you exchange a portion of your gross pay for the use of the bike or item. Your taxable earnings come down as a result, which means you pay less income tax and less employee national insurance contributions. And your employer similarly pays less employer national insurance contributions too. Those lower tax charges are where the scheme savings come from. Over 1.6 million UK employees across more than 40,000 employers have used the scheme since it's launched, and it's typically administered by providers like Dash Rides, alongside Cycle Scheme, Halfords, Cycle to Work and Green Commute Initiative. Most UK employees using the Cycle to Work scheme save between 28 and 47% on bikes, e-bikes, cycling equipment and bike share rides through providers like Lime and Forest. The saving is a combination of income tax and national insurance contribution savings, and the exact figure depends on your personal tax circumstances, with some people in the personal allowance taper zone saving over 62%. For most people though, it breaks down like this. If you're a basic rate taxpayer earning up to £50,270 per year, you typically save 28%. That's 20% income tax saving plus 8% employee national insurance saving. If you're a higher rate taxpayer earning between £50,270 a year and £125,140 per year, you typically save 42%. And if you're an additional rate taxpayer, you typically save 47%. What this means in practice is that a £1,000 bike costs a basic rate taxpayer around £720 on a net basis, a higher rate taxpayer pays around £580, and an additional rate taxpayer pays around £530. In Scotland, it works slightly differently with their 6 income tax bands rather than the rest of the UK's 3. There's a savings calculator in the description that will give you your exact figure. Nearly everyone in the UK who's paid through PAYE, full-time, part-time, fixed-term and director employees, provided their employer offers the scheme and provided the salary sacrifice doesn't drop their pay below the national minimum wage, is eligible for the UK Cycle to Work scheme. The scheme isn't available to the self-employed. That's because the underlying exemption, section 244 of the Income Tax, Earnings and Pensions Act of 2003, attaches to employment, not self-employment. If you're a limited company director who's also an employee of your own company, you can qualify. If you're a sole trader, freelancer or contractor paid outside PAYE, you can't. For any employer to run the scheme compliantly, 3 base conditions must be met. It has to be available to employees generally. Anything obtained through it must be used mainly for qualifying journeys, and ownership of any item can't transfer to the individual as part of the Cycle to Work hire or transaction. One important detail on the national minimum wage point: salary sacrifice can't legally take your gross pay below the statutory floor. So if you're paid at or near minimum wage, you may not be able to access the full salary sacrifice savings. No, you don't have to cycle to work every day. The scheme only requires that the bike or item is used mainly for qualifying journeys, where mainly means more than 50% of total use. There's no formal record keeping requirement. You don't need to log your mileage or keep evidence of usage. This sits in section 244 of the Income Tax, Earnings and Pensions Act of 2003, with detail in HMRC manuals EIM 21664 and EIM 21850. Qualifying journeys include your commute between your home and workplace, journeys between workplaces, and trips on a working day to shops or amenities within roughly a 10-mile radius of your workplace, which is particularly useful for hybrid and remote workers. Leisure rides and family member usage are also fine, so long as they're not the main use of the item. Anything above the qualifying journey threshold is your business, so you're free to use it however you want. At the end of the cycle to work hire period, you have three options. Keep using the bike for free under an extended use agreement, return it, or pay fair market value to take ownership earlier. The default at most modern providers is what's called the free extended use agreement. You keep using the bike at no further cost until it reaches 6 years old, at which point ownership transfers to you either by way of gift or for a nominal payment, with no income tax or P11D consequences. 6 years matters because of HMRC's EIM 21667A valuation table. The table reduces the assumed market value of the bike as it ages. A £1,000 bike, for example, has an acceptable disposable value of £250 after 12 months. That's 25% of the original price. At 6 years, the table suggests the bike has a negligible market value regardless of what it cost originally. So a free transfer at that point triggers no Class 1A national insurance contributions and no benefit in kind tax either. The other two options are simpler. You can return the bike, or you can pay fair market value to take ownership earlier, typically around 18% to 25% of the original price after 12 months. One important detail, HMRC requires the initial hire agreement to contain no mechanism to transfer ownership. Any transfer has to happen under a separate agreement entered into at that time, not promised upfront. The Cycle to Work scheme covers a wide range of cycles, from standard bicycles, electric bikes, cargo bikes, folding bikes, tricycles, four-wheel cycles, and adapted cycles for differently abled riders. You can also include cyclist safety equipment, items like helmets, lights, locks, reflective clothing, panniers, child seats, and replacement parts. The legal definition of a cycle sits in section 192 of the Road Traffic Act 1988, a bicycle, tricycle, or cycle with four or more wheels that isn't a motor vehicle. Electrically assisted pedal cycles, also known as e-bikes, are included, provided the motor is rated at 250 watts or less, only gives assistance while you're pedaling, and cuts out at 15.5 miles per hour. Most major cycle to work providers stock all eligible categories, though product range varies. It's therefore advisable to check what each provider lists before signing up, and if it is a voucher operated scheme, note these can be limited to only participating retailers. See a comparison table in the link below to see more. Yes, certain cycle to work providers, like Dash Rides, offer flexible access to Lime, Forest, Voy, Beryl and Santander Cycles through the Cycle to Work scheme. These are fantastic services, enabling many more people to cycle to work than previously, and therefore fully to be encouraged. All qualify for the same 28 to 47% salary sacrifice savings as the traditional variant of the scheme. HMRC's EIM 21664 guidance confirms that bicycle share schemes can fall within the Section 244 exemption. For share arrangements, the manual treats cycle as any cycle used under the scheme, which neatly solves the "you ride a different bike each time" problem at the legal level. There are several reasons UK employers choose to offer the Cycle to Work scheme, and most employers care about more than one of them simultaneously. They are talent attraction and retention, employee health and well-being, lower employer national insurance costs, sustainability, and employee productivity. On the health side, employees who cycle are estimated to take between 2.1 and 4.5 fewer sick days a year, according to Cycling UK. They're statistically less likely to suffer from mental health issues, and they tend to have better concentration and creativity levels than their non-active commuting counterparts. On the cost side, employers save up to 15% in secondary Class 1 national insurance contributions on every salary sacrifice transaction. Put another way, That's £150 saved for every £1,000 processed through the scheme. On sustainability, replacing car commutes with bike commutes contributes to Scope 3 emissions reductions, which supports ESG reporting under the UK's streamlined energy and carbon reporting framework. For these reasons, employer participation in the scheme is very broad, and on uptake, this is where the modern voucher-free providers like Dash Rides really pull ahead. Based on internal Dash Rides data, we see employee participation rates 3 to 7 times higher than traditional voucher schemes, which means all of the benefits above land even harder for you. Offering the Cycle to Work scheme does not cost UK employers anything. In fact, in many cases, the scheme either makes the employer money through national insurance savings, or it runs cost neutrally where those savings are passed back to employees. Employers save up to 15% in secondary Class 1 national insurance savings on every salary sacrifice transaction, which put another way is £150 for every £1,000 processed through the scheme. Where it can get difficult is working capital. Traditional voucher schemes typically require the employer to fund the bike up front, then recover that cost over the salary sacrifice period, which can be 12 months or more. That leaves the employer out of pocket in the interim, and at scale can create a real cash flow drag. Modern providers like Dash Rides solve this by funding the bike themselves and invoicing the employer only as the employee deductions are collected. One regulatory point to consider is that schemes covering bikes or items over £1,000 require the operator to hold specific FCA authorisation. The £1,000 isn't a cap on what you can buy, it's the threshold above which the provider needs to be authorised. Most established providers, including Dash Rides, hold the necessary authorisation, so transactions above that figure aren't a problem. When comparing Cycle to Work providers, there are 6 aspects worth evaluating: the scheme model, the range of services offered, the product range, administration time, and the employer funding model, and most importantly, the employee experience. The scheme model is probably the biggest notable split. You've got voucher schemes like Cycle Scheme and Halford's Cycle to Work, and you've got voucher-free online stores like Dash Rides. It's widely recognised that voucher schemes can be cumbersome for employers to administer and for employees to use. The voucher-free model, however, like the kind operated by Dash Rides, sees between 3 and 7 more times uptake as a result. The employee experience, however, is ultimately what determines whether your scheme actually gets used. Some providers limit you to a selected range of bikes or retailers and restrict employees to only transacting once per year. Others give access to any eligible product from any retailer and unlimited transactions per year. That difference shows up directly in uptake and employee satisfaction. The range of services matters too. Some providers offer bikes and e-bikes only, others add subscription services and bike share to ensure the scheme appeals to a broad range of employee preferences. Administration time varies sharply between providers, from a few minutes a month at the light end to far more involved commitments at the other. The hidden cost here is employee support, explaining how the scheme works, fielding queries, troubleshooting. That's often the biggest time sink, and it's the one employers don't see until they're actually in it if they choose the wrong provider. The funding model is about cash flow. Some providers require employers to fund the voucher value up front. Others can manage the funding themselves, which keeps the scheme cash flow neutral for the employer.